This is the 20th year we've been doing these market outlooks in Melbourne.
Once again, we've had a pretty interesting start to the year, and I think once again has characterised our markets over the last couple of years. What's going on from a bigger picture point of view, the global environment is really dominating a lot of our thinking about the outlook for the market. A whole host of factors appeared on the global stage that have destabilised investors, caused them to question the more positive attitude that we had building up through last year. So to what extent is it justified? You know, people are concerned that China's going to collapse, that the US is going to go into recession. To what extent do we think that these are valid? But our view generally is that the reaction of the stock market was an overreaction. But that uncertainty about what the future holds is exactly one of the things that's been very positive for real estate, because the combination in real estate of a real asset with a relatively high contractually guaranteed income has been very, very appealing, particularly given that you get that downside protection from a real asset, but you get growth opportunities if the economy recovers and things start to improve.
The economy hasn't been as hot as the weather has in some of the cities recently. But reality is we're still growing in that 2.5% to 3% range in Australia. But it's a nation full of divergence at the moment. If you're in the southeast of Australia, you can see very strong growth. In fact, Victoria, it's a really good place to be. 4% annualised demand growth. So it's actually the strongest economy at the moment, with all the components growing positively, which we don't see across other states. The whole economy isn't affected by the mining downturn, and it looks like it's steady as she goes through most of this year. And our base view is that the interest rates will stay low, but fairly steady, in line with that continuing economic growth in that 2.5% to 3% range.
Ladies and gentlemen, we'll now take to our panel experts and have a think and a talk about what we heard from our research colleagues, but then dive into the respective markets that we heard a little bit about.
The asset services industry is going through a bit of change at the moment. We've had a very healthy market in Victoria recently. We've got good job growth. We've seen a 4.2% increase in customer sentiment in February, according to Melbourne Institute. And that's led to some really interesting requests and demands, increased demands from our clients and in turn their customer. And I use the term customer very pointedly because I really believe that the term tenant is dead. That feudal relationship between landlord and tenant is just being flipped on its head. It's no longer the case of landlords dictating how a building will be run and how a building will be presented, because more and more we're seeing that their customers, their clients are demanding from them different ways that they can work in their buildings. Landlords are recognising that the built form is one of the most immediate and direct ways to influence culture. And so as asset services providers, we have a carriage of that for the landlords. We need to work very closely together to ensure that that culture is being seen in the way that the building's being run, the way that the building's being presented. It's a very powerful piece for our clients.
Mark Coster, let's have a chat about this weight of money that's looking for a home.
2015 was a really, really active year. It was a massive amount of capital sort of coming into Australia, and to a certain extent quite a bit leaving as well. But for every every buyer we lost, we got a new buyer coming back in again. In some instances we had two. But what we did see in terms of that flow of capital was, for the really, really big trophy assets, just less bids than what we saw in 2014. And we think that's a recurring theme for 2016. So you'll see really, really strong pricing still. And we still think cap rate compression is going to continue, albeit at a slower rate. But you won't see the number of bids, particularly for those larger assets.
The Melbourne office market's an exciting place at the moment. I think we've got a good vacancy rate at 7.7%. Inquiry is strong. We've got a good development pipeline underway. So I think it's all the fundamentals of the market speak well. And it's interesting to hear the conversation here today. It's very reminiscent, I think, of sort of 10 years ago when we had a 3% vacancy rate, where the conversation turned away from all the dollars and cents and started looking at things about tenant retraction and tenant retention.
We're definitely not in 2015, that's for certain. And Australia 108, we keep talking about it, is a macro symbol of a rampant market. We're not going to have an Australia 108 in 2016. That's just a fact for lots of reasons. General sentiments come off. The banking's attitude to our sector's changed. Demand is still very strong from overseas, absolutely, and will continue for the reasons that our researchers have outlined today. but it's pockets. You know, Melbourne has supply issues in pockets and it has great stories everywhere else. So we're incredibly excited, our Resi team, about 2016.
Each year you give us a bit of a snapshot of who's doing what, but if we compare the different forms of Asian capital, what are they all up to?
This was originally an aerial which actually showed the concentration of suburbs where we have more than 15% of Chinese population. And the reason that I wanted to put this slide and this slide only up is because I feel it gives enormous context to the question around China. And quite often we're looking back to the history to understand what happened with the Japanese, what happened with American capital, what happened with Canadian capital. This is why it's so different in a place like Melbourne, and this actually is why we've got such great opportunity ahead of us if we sort of plan for it in a smart way.
Dean Hunt, let's talk about the glamorous world of sheds.
We probably saw something in the order of 81 transactions last year, which was almost double what we saw in about 13. So with that momentum, and we heard Stephen talking in the research presentation about their momentum into the end of last year, we really did feel that. And we see that continuing through if we look at the amount of inspections that are happening, the amount of transactions that are on the books right now. That's going to continue through into 2016.
It gives me great hope that we can change our language from being very commoditised markets that people feel that there's not a lot of difference, to where we can think more deeply about our customer, why might they want to be there, and talk in a different language around productivity, around wellness if it's that. And I actually think another piece is that will be bigger than wellness, will actually be digital and technology. I think wellness is clearly very important, but one of the biggest changes that are going to be coming for our industry is around digital and technology. And interestingly, as masters of the universe in this room, we think we have all the answers, but I think very carefully, there'll be some very interesting changes in the industry over time in terms of who will actually lob up on our front door and show us how to do it better. And particularly in the technology sector and what our buildings need to do to bend and flex to the new world.